Yep, we are ready to start. Gary, if I can take the opportunity to quickly introduce you. Yep, excellent.
Yep.
Good afternoon and welcome, everyone. It is a real pleasure for me to introduce you all, our guest speaker for today, Mr. Gary Fawcett. He is here accompanied by our good friend James Carrick. They both are from the company Bruin Dolphin, and you may already know about the company that it is one of the largest asset wealth management companies in the UK. And I was just checking this morning about the size of the portfolio the company manages. It's huge. It's about 50 billion, I guess, and the number of customer base is also huge. But if I see the per client amount in the portfolio, it's about 1 million. So it's really great that we have someone from such a large and reputed company going to speak with our students today. So thank you very much, Gary and James, for taking out from your valuable time and speaking with our students. So I'll just pass it on to Gary and James. And I think we do not have any set rules regarding when our students can ask the question. So they can ask the question as and when they think they have a question to ask, but we will still have a question and answer session toward the end. Is that okay, Gary?
Yeah, thanks, Binam. Absolutely fine. Please do chip in, anyone who has a question as we go through it. Just stick your hand up and we'll try and get to you as soon as we can, but or just speak up, whatever's easiest for you. But it's best to make this as interactive as possible, because listening to James and I talk for goodness knows how many minutes could be quite painful. So I'll just crack on if that's all right, Binam.
Yeah.
But thanks very much. Nice to see everybody. And I'm going to share my screen and we'll set out what we're going to be talking about. So just bear with me. Hopefully you can all see that.
Yep. Yes, we can. Yep.
Okay, for some reason. Right, so let me just put you on this screen. So yeah, so you can still see our slides. Yeah. Okay. So that's a lovely picture to start with. I'm not quite sure where that is, but it looks pretty nippy. So James kindly put that image on as our starting slide. But what we're going to talk about today is obviously who James and I are, our position at Bruin Dolphin and how long we've been here. We're going to talk about the company itself and how we help clients and what the process is regarding helping clients from the very first meeting that we have with them to how we manage investment portfolios for them and how that changes as they go through their life, because it's not a straight road. There's lots of twists and turns on a client's journey, and we have to be able to adapt with that. We're going to talk about how we build portfolios and what we look for to meet individual objectives for clients, because everybody's different. So we'll talk about that. I'll give you a flavour of what our current thinking is on markets, where we see things going, the challenges, the opportunities, and then obviously if there's any questions at the end, but please do ask questions as we go along. Feel free. So my name's Gary Fawcett. I head up one of the private client teams in the Newcastle office. So my team looks after about 750 million client assets. We've got over 1,000 clients on the team that we have to look after between us all. The office in Newcastle manages about 2.5 billion of client assets. So we are a big player in the Northeast marketplace. One of the largest, and as a group we look after around 55 billion. But I've been at Bruin Dolphin for just over 21 years. Started as a graduate trainee back in 2000, did a work placement at Bruin Dolphin back in 98, and was lucky enough to be kept on during my final year. So that's my history. And so, it is a great place to work, and hopefully, that the fact I've been there that long suggests that. But I'm probably one of the newbies still. There's lots of people who've been here 30 years and over. So James hasn't quite got there, but we'll do soon. But I'll let James introduce himself.
Yeah, no problem, Gary. So I'm James Carrick, and
well, put it this way, I haven't been as long as at Bruin as long as Gary, but I started funny enough, it was Halloween 2016. And for me, my background was simply I did an economics and finance degree at the University of Leeds. I did a brief study abroad year out in Hong Kong, so I lived there for a year. And really, when I came back, it was very much exploring what I wanted to go in terms of a career, and I felt like wealth management was a good fit for myself because I was always interested in investment markets. But I would say so that I'm very much a people person. I think finance is an interesting topic, but when you've got personal needs behind the scenes with a life story behind it, I found that pretty interesting to start out my career. So yeah, I joined Bruin, like I said, in October 2016 with a view to ultimately be qualified as quickly as possible. I went through all the exams, which a few of you may want to ask me later on in the talk. And really, yeah, I've kind of worked with Gary's team, and Gary and I work closely together on clients. I've got clients of my own now, and very much it's a collaborative team approach to looking after client money. So yeah, that's my kind of background, but I'll pass you back on to Gary to show you how much money we do look after for clients and kind of a wider Bruin story.
So this slide just summarises where we're at. We've got 34 offices around the country, so we're a national business. We've now got a big operation in Dublin as well, which we bought a few years ago. So that was that's proven very successful. As Binam said, we've got over 50,000 clients, and collectively we look after just over 52 billion of client assets. We've been going since 1762, which is when we were founded. So we've been through a fair few ups and downs in the stock markets over those years, and we're still here. And so we know a thing or two about how to manage crises, and most recent ones being, the pandemic, the financial crisis, the technology boom and bust. And in my career, I've been through those three already. So it does, affect how you view the markets, and an experience accounts for a lot, and clients look to that experience because you've been through it. You hopefully can navigate those choppy waters for clients much more adaptedly as a result of that. So we built up a lot of collective experience around Brewin Dolphin, which is why our client satisfaction rate is very high, particularly compared to the industry. So we're clearly doing the right things for clients. Clients are at the heart of everything that we do, and our processes, our business, and that's reflected in that. And we've grown over the years. We employ over 2,100 people now, and have over 475 qualified advisors. So we are in a good position. How we help, we've developed our services over the years so that we can reach a broader array of people. So we've got our Bruin Portfolio Service, which is for people who are setting off on their investment journey. And that's a really good offering. It's on a model-based approach, and it's aimed at people who've got £2,000 to invest at the start but want to then subscribe monthly. So it's a really good, we use that a lot for junior ISAs, for children, and people who just need to start put away for the longer term. So it's a really great introduction into the Brewin Dolphin family. And then we've got our Wealth Pilot service, which is geared towards clients who need more general financial planning advice, or starting to talk about pensions, how much they should put into that, and longer term planning. So that comes into it at that point. And then our core service is wealth management, where James and I sit. That's for clients who've got larger pots of money for us to invest for the longer term and have more tailored needs that we need to take into account. So we can, we've developed our services over the years so that we can cater for more people in a much better way. So which is a great offering. But with regards to the core service of wealth management, it's split into two. So you've got financial planners and you've got investment managers. So financial planners looks at the holistic planning side of the business. So that's looking at pension planning, protection issues, general tax planning, and inheritance tax. And so that features on the bigger picture stuff. And on the investment side, which is where James and I sit, we look to then manage the investments within any of those particular wrappers, whether it's a pension wrapper, it could be a family investment company, It could be ISAs or a trust. So we come in and manage tailored portfolios for clients' needs. But most clients that sign up with us now require the wealth management service, so the financial planning and the investment side of the business. I'm going to hand over to James just to talk through how we do things.
Yeah, no problem. So as Gary was saying, obviously everyone's different and everyone we meet has a backstory or a financial need of some sort. And generally the mission is for, it's all good and well having a pot of money that you wish to invest, but you need to know the purpose behind the scenes. Now this slide obviously sums it up quite nicely. Oops, gone. There it goes. It's back again. So really, we have a bit of an exploratory conversation with the client to start with and to find out what their needs and objectives are. And really, you've got to look at what you want to achieve today. Obviously, you've got to look at what your personal goals are. Some clients might have a family that they wish to pass on at some point. Some people might have an assistant sort of future capital requirement later in life. You might think, I've got a disability, I'm going to potentially need care when I'm older. And really, it's just to have a wider conversation to basically prioritize where and what you feel like you want to have in terms of an objective of what you want your money to do and what we as a company invest on your behalf for. So Gary, if you just, can I request control here actually? That's fine, I'll just tell you to move on like Chris Whitty. So really this is a snapshot of a typical financial journey, and don't get me wrong, it can vary massively depending on what someone's job title is or where they are on this journey, but really there's a lot of facets to someone's financial needs and their financial makeup. So as you can see here, this chart is very much when you start out on your investment journey, it's ultimately trying to have a better return than cash. And I'll come on to obviously the impacts of inflation and interest rate and how we build portfolios later on. But really, it's basically to, as I said for my last point, is you can see there estate and retirement planning. Inheritance tax is something we do a lot of work around. Tax planning. Tax is a phenomenal thing that we obviously work to day in day, and you've got allowances which we'll touch on later, but tax planning is very, very important to how we run money, because it's all good and well the stock market going up, but if the client potentially might be taxed heavily, if it's not efficient, we come under scrutiny, and really we want the best outcome for our clients. So we've got a lot of tools that we can put together. Gary, if you go on to the next slide. So here, it's quite a nice little summary of how we sort of do things on a day-to-day basis, and it's really it is very much a merry-go-round, and generally we start out, as I said, with the needs and objectives of the client and find out their personal and financial circumstances. But this is when Gary and I really come into and use our expertise in order to invest the funds for our clients. And a lot of it stems on risk. And there's a few slides later in the presentation about why risk is important. Yes, everyone wants to double their money in the next 6 months, but everyone's different. You've got clients that don't really or can't really afford to take too much risk with their funds. Some people do. So generally the younger type of investor can invest a little bit more high risk on the basis that they've got a lot of years ahead of them to ride out those bumps in the road along the way. If you were going to have potentially a 90-year-old come to us and say, James, Gary, I want you to invest in highest risk possible, there's a bit more of a conversation that we have to have about attitude to risk and basically think, do you really need to take that amount of risk? So there are a lot of things in terms of risk we have a chat about, and we use things like a client risk questionnaire to help us satisfy that the client's taking the right amount of risk at any one time. And really, once we've had a broader conversation and got down to the nitty-gritty of whether capital growth's a preference or income and stuff like that, really we'll come out with a recommendation. Now, you might think, there we go, you've got a portfolio, crack on and invest. Well, as you everyone's lives are different. Things can crop up from time to time, and really it's an ever-moving vehicle really going forward. People get married, people need funds for marriage, people have children, people want to pass on their wealth to the next generation. Big client circumstance changes such as divorce, for example. So there's a lot of different moving parts that can happen that can affect not only the objectives but the risk as well. So we constantly review things as we go part through sort of looking after a client. But I suppose when we have that conversation to the client, generally we can stem back to the fundamentals, and this slide here very much is quite topical, given the fact of what's going on in the marketplace right now is the impact of inflation. Now this chart, it simply just shows you that if there's a high level of inflation in the marketplace, generally, given where interest rates are at the minute, everyone knows you're not going to get any interest in the bank whatsoever, really. And it has a real detriment effect to the real value of cash. And really, Gary's and I's jobs is not only to invest money to obviously make a return, but if we're not beating inflation every year, the real impact of clients can be big. So even before we set up our risk and all sorts like that, there's a real power to investing. In this chart here, you can see that if you invested about £100 way back in 1900, I doubt anyone's alive now. But really, it just shows you the power of equities in particular, which we'll talk about later on. But having that balanced view is investing doesn't have to be a scary thing. It's Gary and I's job to ultimately invest on your behalf, but our expertise are well placed to therefore invest in something that ultimately will grow money over time, or grow your capital and income over time. And speaking to you today, really, you can see this chart is, yes, you might have a good year. Sort of the past 12 months as we came out of the pandemic was a particularly good year as we had a lot of stimulus in the market. But what you can't overlook is, you probably learned in a few studies or modules, is the compound interest. So that orange line there is for investor one that invested way back in May 89, when Gary was not as old, let's say. But generally, you can see that just the power of starting early, and that compound interest makes Gary and I's job even more powerful when we can reinvest any sort of dividends from company, the returns, and generally over time, it has a massive impact and it's massively advantageous, put it that way. But if you flip on,
but it's one of the reasons as well why we looked at starting the Broom Portfolio Service, because actually, if we can encourage people to start saving earlier in their careers, when they finish university or through university or when they get a job, if you can, taking out your pension with the company as soon as you can, even if it's just a little bit, this just shows you how important and how impactful it can be, rather than leaving it until you're maybe late 40s when the financial pressures have eased a little bit, but your time frame is much shorter, and it means you have to put a lot more away each month. So starting early, even small amounts, can make significant differences longer term.
And I'm not sure if any of you have been in the talk from Gary and I before, but I think Brew and Dolphin or other wealth management companies get added, you need lots of money to invest. Well, clearly with the number of services we now have for different people, is you can start early and you can have that compound growth now, thinking that even if you put a few pound away each month, that really does have an impact. You'll be surprised at how many sort of wealthy clients that we have that have invested, I don't know, £100 or £20 a month into a junior ISA, come back a couple of years later and go, wow, that's a fair bit of money. Whereas 20 quid go on a couple of gin and tonics in Newcastle or whatever these days. So generally, it does have a massive impact. And here, this chart, it's quite interesting, especially what we've gone through over the past couple of years. Is you've had this big blips along the way, and at the time they feel like a big blip, but especially when you look there, I mean, supposedly for the audience today, looking at the global financial crisis, and Gary lived through that, especially from a work capacity, is that seemed like the end of the world. It genuinely seemed like the end of capitalism and the world we knew it, in terms of banks going bust and generally complete going back to the clean slate. Now you can see there from that chart, you wouldn't really notice any difference there. And it's phenomenal. It even surprises experienced investors at how well markets do recover and how resilient they actually are.
But at the time, markets fell about half. From peak to trough, they fell about 50%. Yet that chart doesn't really show that, because obviously over the long term it irons it out. Now you can never say never. There might be a period whereby the markets don't necessarily recover as strongly, but you can see from all the major setbacks the world has had, it has come back, and it's come back from the most recent, which is the pandemic. And obviously there's lots of things affect that. You've got a lot of government support, a lot of central bank support. That kind of stimulus changes as depends what you're facing. But the point of it is, long-term investing, generally favours coming out the other end in pretty good shape. You just can't capitulate when the market's having a real wobble. It's about making sure you're invested in the right things, and just that will be that businesses that will be here after the crisis is finished and that are stronger and that will perform well. So that's our job. We're not there to try and time the market. We should take all the cash, we should put it this. We don't do that. We just make sure we're invested in the right areas at the right time.
Mm-hmm. And it's funny, from that chart there, you think, well, Gary, James, should we just put the money in the market now and forget about it? Well, arguably you would say yes, but we've had a number of investors that have been invested a long, long, long time and have seen how how resilient it is. And we had a few clients when we went into the pandemic literally instruct us to sell some investments and go to cash. Now, this is when it kind of stems back into the conversation of risk. So it's all good and well, Gary and I investing on your behalf, but what we call it's composure to risk. So people do, in the face of crises, do panic. And it's Gary and I's job not only to have the money in the best place for them, is also to be that helping hand to say, listen, we've been here before. We know how markets recover. By all means, make changes. And Gary and I did make some changes that have worked out favorably for the portfolio. But generally, it's like that ever-moving beast of that risk conversation. So
James,
it's very important. Yeah.
Nathan had a question. So Nathan's question is, Hi, James and Gary, how do you approach a problem of inflation for a client who may be risk-averse and so would usually have a high proportion of bonds in their portfolio? So we're going to talk about risk, but you're quite right. And this is a problem that we came across coming out of the financial crisis. Interest rates went from around 5.5% down to 0.5% very quickly. And so, clients were used to getting a lot of money, a lot of interest on savings. And, we've never been back then. It's unlikely that we ever will. So all of a sudden, money needs to work harder. So it has brought more cautious investors into the fray because they realize they've got to make their money work harder. So we do run lower risk portfolios, which means having more investments in safer ends of the market, such as bonds, corporate bonds. Alternative investments could be absolute return funds, hedge funds, commodities, so gold and what have you. So I would say, we can buy inflation-linked bonds. So which is what we've been doing. So if you think inflation is going to take off, look at the assets that actually are a good hedge against that. Inflation-linked bonds are a very, very good hedge against inflation, and it's obviously backed by corporates or governments mainly around the world. So you would allocate more to that. Property tends to be quite a good hedge in some cases. So again, you might look to allocate a bit more to commercial property. Gold tends to be a decent hedge against it. So you put some more towards gold. And then you look at certain equities. Different sectors perform in different ways depending on the inflation story and the interest rate story. So, inflation taking off and interest rates starting to grind higher doesn't generally bode well for the technology sector and growth sectors. Financials, so like the banks and insurers, and value stocks tend to perform better in that kind of environment. So again, it's about having the right asset mix that client's comfortable with. If they've got no risk appetite at all, then they shouldn't invest, and they're just going to have to come to terms that their money is going to fall in real terms. We can't, nobody should be investing in the market if they can't stomach the risk, because it's just not going to go the right way. And what will happen is you'll have a financial crisis or a pandemic and they're going to panic and they're going to sell. That's the worst thing. So you've got to have some appetite to take on some form of investment risk so that you can get that more balanced approach. How much risk you take is a different matter. But if you've got no appetite, don't invest. So it's there are lots of ways we can hedge against inflation, and that's clearly what we're doing at the moment. And I'm going to talk a little bit about our thoughts on inflation in the presentation. But the question is, is inflation here to stay, or is it more temporary? So I'll talk about that.
So this slide here, yep, that's fine. This slide here very much just shows that generally Brewin Dolphin are one of the best wealth managers out there in our opinion, and the figures actually show that. And this just shows you that it's generally we have outperformed the WA benchmark. So that's just very much a peer group that kind of collects a lot of our competitors together, and generally we have been outperforming over the years. It just shows our expertise, and obviously it's a good thing to see when that comes out. But yeah, kind of it's always going to stem back to risk, and Gary was touching on it's the individual needs, and I think you would all appreciate the fact that generally, yes, the more risk you take, the more returns you generally get, and figures prove that. You can see here that risk level 8, which is our highest risk level for our clients, and it's basically 100% equities. It obviously does outperform lower risk categories such as risk level 3, and that's generally sort of mostly in safer stuff such as bonds. And don't get me wrong, there's some environments where you've got lower risk portfolios doing better than the higher risk at times in the economic cycles. So it's a moving beast, but generally I think everyone would understand that. Now I touched on sort of the risk level 8 there. We run money from basically you've got a scale of 1 to 10, 10 being the highest risk, 1 being effectively cash. And realistically, when we're building portfolios, we have and offer the service between risk level 3 and risk level 8. And as you kind of go through that risk level direction, obviously, the more we put into, let's say, higher risk stuff such as equities, which can and are usually more volatile than things like bonds. Not the fact that equities don't always make more money than bonds at certain times, like I said before, but really that's how we kind of run money for our clients. And I'm going to keep banging back to this sort of diversification and risk all the way through the presentation, which is a common theme. And I won't delve on the specific figures here, but it is quite an interesting thing when you're looking down at certain colours here. And really, this slide sums up Gary and I's expertise in the fact that we need to balance the investments. Diversification is a massive key to overall long-term performance of trying to smoothen out the curve of returns over the time. And that sort of dark blue line, well, let's say dark blue color as you kind of go through the years, that shows what a diversified portfolio does. Now, obviously, if you were going to draw a line, you can see straight away that it's less volatile. Now, don't get me wrong. If Gary and I had a client that said, I want the highest risk possible, we still need to diversify investments because you're going to have so much volatility within the portfolio. It's going to be quite hard to manage at times, but we want and we do put money, generally the best companies that we feel are the companies of today and tomorrow. And that's what we do, but we need to have that balance in short. And this slide here very much sums up sort of Gary and I's conundrum every time we have a look at a client portfolio or generally new money as well. And you can see that obviously we've discussed inflation, which we'll come back to later on. We're active, so people say, well, why don't I just stick my money in a tracker in the US, or for example? Yeah, don't get me wrong, it's done really, really well. But you've obviously got to manage that yourself. But what we do is, Gary and I have the expertise to say, listen, the US is actually quite a hard market to outperform by chopping and changing or having certain approaches. So by all means, we have got the ability to buy a tracker in the US, but we blend that as well with certain themes that we like. One being technology, one being healthcare, for example. And really, there's different places in different parts of the world where Gary and I think that generally an active-based approach outperforms a passive in this area. So we'll implement that strategy. And we're not going to say that we're active managers. And don't get me wrong, we'll want to outperform our benchmarks and stuff like that. And we'll just put the money in the right place that we feel that will outperform our benchmarks. I could just see a question coming in. Can we have some insights about the colour boxes?
Right. Binam?
Yes,
So,
just for the interest of students who are looking into diversification through different methods, such as very simple correlation matrix type of thing. I was guessing if it is something similar, or perhaps you can also mention about, the on the right hand, you mentioned things like UK equities portfolio and so on. So where is the correlation or less correlated series that may be of your interest? That type of thing, please.
So you've got to remember, obviously, you've got firstly different assets. So you've got bonds, you've got commercial property, and then you've got equities and you've got cash. So they're going to do different things depending on what the economic backdrop is, depending what support there is from government, central banks, what inflation's doing, what interest rates are doing. So we take a view that if the economy's going to come into a difficult patch, then government bonds will do particularly well. If inflation's going to be subdued and interest rates are going to be held or going to fall, then that'll be support bonds and other assets. Commercial property tends to do well. It depends. For example, commercial property, even within that space, you've got the likes of warehousing, industrial property, retail property, office space. These performed very differently. So we then choose where we think the best opportunities are in that space. But looking at the equity markets, you can see there's some stark differences. So just look at 2020. Asia was the best performing market, followed by America. Japan was up there. Then you had index-linked bonds. What's this one? This is UK corporate bonds. So where was the UK? Was grey. So that's about here. And so you think, depending on your view of what type of sectors are going to perform well, could dictate where you want to add more money. So, for example, America is heavily skewed towards technology stocks, healthcare stocks, some big consumer staples. It's quite a defensive market in that sense. And so when you think about how the likes of Microsoft, Apple, Google, Facebook, Tesla, all of those have performed, it's no surprise that America is one of the best performing markets. Now, if you still think growth is going to outperform value, then the likes of America and Asia are likely to continue to perform better. If you think value will start to have its day because inflation is going to be more permanent and interest rates are going to start ticking higher, which will benefit the likes of the oil companies, the financials, the more defensive sectors such as pharma, as in pharmaceuticals and utilities, then actually you'll find that Europe and the UK would probably do better than America. So it very much depends on where you think the economy is, what type of companies are going to, what kind of sectors are going to benefit because of where we are in the economic cycle, and therefore what type of businesses will benefit. And the world's markets are actually quite different from what makes up their stock markets, what is the dominant force behind them, which is why the US has been a standout performer for a number of years now, is because tech has just marched, and we lack that technology influence in the UK. We haven't got the same makeup. I think pretty much about 25% of the FTSE 100 comes from financials and oil and a bit of telecoms. Now, it's no surprise that in the financial crisis, they were some of the worst hit in consumer goods, where America was mainly tech and healthcare, which were sectors that were doing phenomenally well. So that's what we take into account, and that's where the correlation lies, and ultimately, it's the thinking about where we are in the bigger picture, what's going to work, what isn't going to work, and therefore where we want to position investments.
No, this is very useful. In my teaching, basically in terms of diversification, we don't do a great deal. We just tell the students that a simple approach such as correlation matrix can be applied. But looking into this slide where you've got all those different markets, and you tend to see the total return, and therefore are able to understand year-wise how the return has been achieved by different sectors. And I can read now the source is Bloomberg, which we also have for our students. So maybe in the days to come in my own teaching, I should be incorporating something similar to this, so that on top of what they do by making use of correlation matrix, they can also make use of return analysis for different sectors. So that's really useful. Thank you, Gary.
No problem. I'll
let James finish.
Yeah, no, that's fine. So this really just shows up the capabilities that we have. But whilst Gary and I are employed to obviously look after the clients, we do have help. And we can't look at everything at all at one point. And generally, you can see in the slide where obviously Gary and I understand the specific needs to a client. And then we obviously our expertise, we know where might be doing well in terms of where we want to invest going forward. But we come together and we've got an asset allocation committee down in HQ. So we've got a centralized research team, which I think we've got a slide later on. But generally, our research team offers the backup to Gary and I's day-to-day jobs, whereby they're actively looking for not only the best companies, the best funds, but generally they're still standing from afar and thinking, what's the best asset allocation for risk level 6, for example? And they're doing a lot of the sort of specific number crunching behind the scenes. So once we have that asset allocation, once we have that help from the research team in terms of recommendations, we then need to put together a portfolio for the client's needs. And this slide here shows that what we tend to do, and I did touch on it again before, so I won't go on it again, but we blend different things together. So the likes of, we've got a collective fund, we've got investment trusts, we've got direct shares for certain clients that are appropriate for. We actively look for funds that are a little bit more passive in nature, such as bond funds, for example. There's a treasury bond fund. Well, we just want that to be invested in treasuries because we feel that's a good area to be invested in for a risk level 5, for example. And it's also comes down to cost as well for a client. So a lot of these funds that we invest in, trackers tend to be cheaper because they just buy the collective, let's say a FTSE 100 tracker. You can it just tracks the FTSE 100 index, and then we surround that passiveness with actively choosing good companies that we want to have more of conviction in, let's say.
So yeah. I'll just chip in there, James. So obviously, as you would imagine, our industry is constantly being challenged about should we just always be just investing in passive tracker funds because you can't beat the index. I don't think that's true. I think it comes down to everybody's needs are different. You know, if you just buy an index, then that's what you get, and that's what your income is going to be, and there's no tailoring it to actually what the underlying client's needs are. But saying that, we've proven that active management works. So our performance, as you saw from our asset allocation chart there, we've been outperforming, and ultimately, you know, not everybody outperforms and not every fund manager outperforms. So if there's a market, like the US used to be a case in point, it was really difficult to outperform in the US. So if you want exposure to the US, the best way is just get a tracker. It's cheap and cheerful and it'll give you exposure. And you can build around that with proven equities or funds that actually have delivered. So the Bailey Gifford American Fund is a case in point that has just knocked the socks off the S&P 500. And so not everybody, not all funds are like that. So we do a lot of work between making sure, you know, it doesn't matter to us if it's passive or active. We just want to make sure we get the right investment style for that market, for the client. And usually active does work. So we're a big advocate of that, but we will complement it with passives where necessary. But active management, you know, allows us to take a position in crises. You know, the pandemic was a case in point whereby we made a lot of changes. You know, we took a lot of consumer exposure out, a lot of property out, and we actually allocated it to America and to private equity and to into technology shares, which benefited. So that's where by having an active management, you can really add value rather than just sitting there with a passive investment, just going up and down in line with the market. So it's quite a powerful approach.
Mm-hmm. And this slide in particular, I think I mentioned at the start of the talk, is yes, we build portfolios, and once we've got the portfolio established, generally, if you look out and you kind of stem out of that for a minute and have a portfolio, Gary and I specifically benefit, and we use these allowances that we have from the UK government in particular. So everyone might be aware of some of these, especially the ISA one, but ISAs are extremely powerful when it comes to helping with returns because tax does take from your overall return profile. So, for example, you can put £20,000 each year into an ISA, and that has gone up over the years. A couple of years ago, for example, it was only about £15,240. So if you can put £20,000 or up to £20,000 in an ISA account per year, then all incomes, all dividends that a company pays out, any capital growth within that pot, any growth that you achieve, if you come to sell that investment, basically it's all tax-free. So everything within it, it's tax-free, which effectively helps from a compound interest point, because there's no tax to pay every year on any sort of dividends or anything like that you make. So it's really powerful. And there's a few clients that we look after who are actually ISA millionaires that have been in the fortunate position to have that ability to put into ISAs every year. And generally, they've got a pot of money in the million or so that's completely tax-free from any sales made, any income, as I said before. So that's one specific example, and there's obviously other allowances there. I won't dwell on this too much, but it very much, you can see from this slide that it kind of covers my point in terms of the research team and the ability we have and the help we have behind the scenes. It's not just Gary and I, which is helpful for any new clients that come on board. And we've got this backing, which is massively powerful. We've won a number of awards, especially for our research team. And you may have seen, especially through the pandemic, we've had a number of new starters in the research team. One in particular, Janet Moy. And she's been talking on the media a lot, sort of Bloomberg TV and BBC and Sky News, and generally just had a much bigger uplift than what our research team has and knows, and just trying to advertise our expertise behind the scenes as well. And it's been really helpful for clients, both existing and new. And then naturally, obviously, we don't want to have a research team that we don't speak to, because obviously they're different type of characters. Some communicate better than others, but we've got obviously the systems in place where we can listen to certain analysts talk every single morning at over 8:30. The market's obviously open at 8, so we have a bit of a discussion then, and emails and all that type of stuff. So we regularly keep in contact with our research team. And lastly, for me, before Gary briefly goes through the market commentary and discuss any questions that you have, this is one of the biggest topics that we've faced in the past couple of years, but I feel this is going to change the entire way we run money for clients going forward, in my opinion. Obviously, we've had that COP26, that's, I think, just finished, or Barack Obama was there yesterday, I think he was. Sustainability, and then the responsible management of how we look after clients' funds. And there's a number of facets to this sustainability question. And there was a lot of, don't get me wrong, there was a lot of fund managers and investment managers in Brew and Dolphin that knew about ESG, but there's a massive learning curve, and it's a very grey area in terms of, again, it comes back to the personal needs of a client. Not everyone's the same. You couldn't put everyone in the same sort of ethical criteria. Some people want to avoid tobacco stocks at all costs. Some people not so bothered, but really want to have invest in companies of tomorrow that will reduce fossil fuels, for example. But what we're finding is, whilst we're actively looking for funds that are investing in the companies of tomorrow, we're just finding it from all areas. And historically, people say, we don't have much choice to invest in responsible and environmental funds and trackers or stocks. Well, you can see from this chart here that it's actually quite worthwhile, and it's only ever going to increase going forward. The performance is there, and it's just shown you how powerful it really is to have funds that are investing responsibly for tomorrow. Now, people say, well, I'm not sure if I'm ethical or not. I don't really know. Just invest in a bog standard fund. Well, even a bog standard fund now, when you look at the top 10 investments, purely on investment grounds, for example, there's a company, Vestas Wind Systems, for example, that looks at wind and solar and stuff like that. That's in the top 10 of a bog standard fund, which kind of shows that it's not investing because it's ethical. It's investing because it's a cracking investment for today and tomorrow. So we're finding that a lot more now, and generally we're incorporating it into most of the client portfolios because the opportunity is there in short. And
we've been doing this quite naturally over the last few years anyway. So our portfolio screened pretty well on an ESG basis, and obviously there is more to go for clients who want to have more of an impact on it. But like James said, it does mean something different to everybody, but it's only going to become more in people's minds. It's going to be top of agendas, and there is definitely, from an investment point of view, a lot more opportunities now to invest in things that do the right thing and actually can be a good investment return as well. And like I said, that we've said there, the performance shows it. So it's definitely right on our radar, and we've just committed this week to become a net zero company by 2050. And so we appointed a head of sustainability a couple of years ago. So we're taking it seriously. But what we needed to do was get our own house in order before we could then go out and then manage investments in a sustainable way and other things. So it is probably going to be one of the hot areas for some time to come.
Mm-hmm. And to be fair, lastly, and I'll let Gary speak about what our current thoughts are, is you're hearing us obviously talk about sustainability and stuff like that. There was a case probably about a year ago where HSBC came out and said, we're going to be carbon zero, we're going to put this amount of funds in being sustainable, and the shareholders turned around and said, okay then, cool, where's the plan? And they didn't have a plan really, and that not only impacted a shareholder sentiment but investor sentiment, and the HSBC struggled. It was massively in the press, negative press. So now you're having big companies and governments now that are being scrutinized left, right and center to genuinely put the plan in place and the money where the mouth is. So it's only ever going to increase from now, which is great to see, don't get me wrong. So watch the space, I guess.
Thanks, James. You'll be pleased to know just a few slides left, and you'll have heard from us. So last few slides are market commentary, where we are at the moment. So the positives at the moment in the marketplace are the US stimulus packages. So Biden's about to sign in his $1.2 trillion infrastructure bill. That will hold on a minute. How do you screen a company is responsible? Therefore, you will invest. Do you rely on third-party info or conduct such screening yourself? A bit of both.
Yeah,
Sorry, go on.
I was just going to say, Binam, we've got, funny enough, I took a couple of slides out of here just because we're short of time, but in short, we do both. For direct equities, we've got a platform called Sustainalytics, where Morningstar helps, and we've obviously got our own research analysts kind of look at this criteria. And we've had a number of clients, for example, that have said, listen, I want to become a little bit more ethical with our approach. Can you screen my portfolio to see how ethical it is? And we've now got the ability to do exactly that. And you have obviously, it basically provides depth to a portfolio to see how it screens, and it's actually been really interesting. And fortunately, it has been more ethical than we thought in certain cases. So like the tobacco stocks, a lot of fund managers have kind of brushed them aside now, thinking long-term growth in this area, despite the big companies, is changing. So yeah, in short, in both. I'm just conscious of the time, but yeah,
thank you, James.
We've got the ability to screen.
What is the name you said? The source
Sustainalytics. We use for direct equities, and in funds we've got the likes of Morningstar, and there's another one, I can't remember what it is, but yeah, direct equities, Sustainalytics is pretty good.
That's helpful to know. Thank you.
No problem.
So so the US, the US is going to spend another 1.2 trillion over the next 10 years on infrastructure. Now that'll be funded by certain tax increases, but they're $350 billion short, which will be borrowed to pay for the difference. So that is a stimulus package because it isn't fully funded by taxes. So that will result in more growth likely to come from the US economy, which is why we've literally just this week upped our weighting towards the to the US by another 0.8%. So we're slightly more of a weight than what we were. And that comes on the back of the stimulus packages that Biden signed in when he first came into power, and which have been very generous. Generally, there's a lot of money sloshing around the financial system, from, the furlough schemes to the checks that the US was writing to individuals, to central banks, quantitative easing programs, to lower interest rates, to support loans by governments for businesses. lots of money out there, and that's helped the markets recover very strongly. It's helped asset prices to rise. It's also fed into inflation a little bit as well. But ultimately, that money is sloshing around. That needs to earn a return. So private equity has a huge amount of money. And so a lot of acquisitions are being fueled by private equity money at the moment. And they're prepared to pay a little bit more than they would do ordinarily. But, when you see a market setback, a lot of this liquidity starts getting added because it needs to work harder, especially when inflation is where it is. That money isn't doing anything. So, that should keep the market globally propped up for a little bit longer to come. There's a lot of pent-up savings. People haven't been able to go on holiday over the last 18 months, haven't been able to spend, go out. So in the UK, there's a chart that I'll show you, but there's about 250 billion of excess savings in the UK. That number is about 1.5 trillion in the US. And so that will get unleashed into the economy as soon as people can book their holidays, go out more. They're doing house renovations, new garden stuff. So there's a lot of money to be spent. And so when the government start to rein in that support that they've been given, my feeling is that the consumer will start to pick up the baton and will keep the economy growing. We do feel that the growth will tail off over the next few years, but it'll still be fairly decent. But I think we've probably seen the peak of the growth globally. That is, and that's been helped by the vaccine rollout, and now the developing world is actually getting the vaccine at a quicker pace. So that will, again, hopefully help international travel and the opening up of more economies. We've said there that, we believe global equities can continue to push high over the next 12 months. Volatility will be a big part of it. We saw September wasn't a great month. We're likely to see further bouts of that, but generally the trend should be upwards. Because there's an acronym at the moment called TINA, there is no alternative. Where else do you put your money? If you've got cash sitting there and inflation's at 3, it's going to go to 4% likely in the UK, if not 5 by next year before coming back. But ultimately, it's losing. So you could put into property, you could put into bonds, but bonds don't look particularly attractive. You could, you could put it into equities, which look more attractive. So people are searching for a home for their money, which is what will keep equity markets, we feel, propelled. On the reverse of that, what are the challenges? Stock markets had a very good run, so they're due. There's always bouts of profit taking along the way. There could be some political bad news. Whether the US and China have a spat, that could set off a little correction. So things like that will crop up. Rising taxes is something, but we now know we've got a global minimum 15% tax on technology companies. We know the UK corporation tax going up, so a lot of that news is already out there. So we are in a slightly higher tax environment. So it's not new, but it's something that the markets have to contend with. And inflation is a big one. Inflation, in our view, is temporary. When we say temporary, we probably mean temporary over a 2-year period, not temporary as in a few months. So it's likely to remain stickier. And the Bank of England pretty much hinted at this. They're going to increase interest rates over the next few months. They'll probably have possibly 2 or 3 rate rises, but they're not going to be as aggressive as the market was pricing in. So the market was expecting interest rates in the UK to be at 1% by the end of next year. It's more likely to be around 0.75%. So it's still very low by historical standards. And as a nation, we are very interest rate sensitive. The government has taken on, obviously, a lot of debt over the pandemic. Consumers have taken on more debt as a result of mortgages at cheaper rates. So a small increase in interest rates is felt. I think the stat is 1% increase in interest rates costs the government 25 billion a year in more interest on the debt. So that will hurt. So I don't think interest rates will be going high too quickly. It'll be a very gradual one. That's what the Bank of England's hinted at. So that should still be quite supportive for equity markets. But again, inflation is very difficult to predict, and there's lots of moving parts to it. Supply chains are a nightmare, as we all know. Demand's out of kilter. People have got money to spend, they haven't got the supply, so it's pushing prices up. And there's a side I'll talk upon, but we can see this slide is just showing the stimulus packages that President Biden has implemented since he came in. This doesn't include the recent infrastructure one, but you can see that his packages have boosted the economy to the point whereby it's now larger than the economy would have been before the pandemic. Now, if we hadn't had it, which is the blue line, it would have faltered. So the stimulus was needed. That's what we're saying. It's the economy's benefit from it, which is why the US has done so well. This is just showing you how much savings there are now in the UK, and actually this more agile working that people are used to. It's also a benefit. People are saving money because they don't have the commute as much as they did have. If you think you're in the southeast, that train travel to London or wherever you might be going is quite expensive. Now, if you only have to do that 2 days a week or 3 days a week instead of 5, that's money in your pocket. And the likelihood is that money will get spent on other things. It probably won't get saved. And so all of a sudden, you've got more stimulus coming into the economy. And so that's why we think, that the economy can continue to keep growing. And I think the Office of Public Budget Responsibility kind of suggested that.
That's just me, Gary. Carry on.
All right. And then from where we are in the current recovery phase, we feel that we're kind of midway to the upper end of the current recovery. So the easy money out of markets has been made, without a doubt. It's going to get more challenging, it's going to get harder. Money can be made. It's just picking the right sectors, companies, countries, and assets. So asset allocation is key, and then the type of sector that will perform well over the next, few years. But we are getting towards that kind of the peak of the expansion, and then we turn into a slight slowdown. So again, it's another reason why we have upped our weight to America, because America tends to perform better when the global economy has peaked and is slightly more on a slowdown trajectory. But we've got a little while to go yet. We still think there's mileage in this recovery. And you can see obviously how the US has performed. We've been invested heavily in the US for quite a number of years now, and it's been by far the standout performer, very much linked to its makeup. But we can see the stronger performance continuing versus other markets. And when I talked about extended share prices, stock markets are trading at pretty much all-time highs. That's predominantly driven by the US. So the US accounts for around half of the MSCI World Index. And when you think of the US market dominated by tech and healthcare, then it's no surprise that global market on a whole has risen strongly. But there are still lots of opportunities to invest in businesses that are still trading very well. About 75% of US companies have reported their earnings now, and generally the beat to analyst expectations has been about 12%. So companies are actually trading better than what forecasts are suggesting or had been expecting. So it's a good position to be in. So the fundamentals we feel are pretty strong in equity investing. Your stocks and shares are not cheap, but they're not expensive. They're not at valuations like the tech boom and bust. They're reasonable for the environment we're in, we feel. So we're quite comfortable with where the markets are. But inflation, we're going to keep coming back to this. It's going to be in the headlines for quite some time. The US inflation rate's over 5%. In the UK, it's currently just over 3%. It's going to get to probably 4% next year, 4.5%. And it's quite interesting because I was talking to somebody that I know who has a business, and he needed to bring some containers from China with goods in to sell in his shops. And what he was saying just recently was 12 months ago, those 3 containers would cost £18,000 to ship across. It's now 63,000. So so those, and I said, can you absorb those costs? He went, no, it means prices are going up next year. So inflation isn't going to just get back to trend. It's going to take some time, and obviously the anecdotal evidence, with when you talk to businesses and people out there, prices are going to stay elevated for a while yet because the bottlenecks we're seeing around the world, which aren't going to ease overnight. They're not going to ease over the next few weeks. It's going to take months for the supply chain to get back to a more normal level. And to a certain extent, central banks know that. They know there's some unique circumstances surrounding the current inflation, and actually by being too aggressive, they'll harm the economic recovery more than they'll benefit it, because energy prices have gone up because of supply demand, but putting an interest rate up isn't going to impact energy. So it'll be like an extra tactical. They've got to be very careful not to, damage the economic growth story and undo all the work that they've done over the last 18 months to get through the pandemic. So a very challenging environment, I think, for policymakers, to be honest. But the feeling is that over the next 2 to 3 years, inflation will get back towards trend. Interest rates won't have to rise too aggressively, and that should still be pretty supportive for investment markets. And our preference would be still to look overseas for returns, such as America, than closer to home. And that is it.
Thank you very much, Gary, and thank you, James, for all your contribution today. So, as James has already written in the chat, all students, participants, feel free to ask questions. I will start with the first, which is about, nowadays there is this trend, which is in a way upsurging about every individual can make investment. So if I go to social media like YouTube, there is tons of advertisement about things like eToro and so on. So just wanted to take your views about how they have, if they have remained or becoming challenging to companies like yours, or you feel that the investment is moving more towards automatization and machine way, or if you think human involvement is still crucial. But it is true that even our students, many of them have already signed up to eToro since they joined the module early this September.
Yeah, I think it's inevitable, isn't it? I think we are heading towards more automation. I think our Broom Portfolio Service is a step in that direction to try to compete in that market, whereby it's not automated in the sense there's still people there, but it's very efficient, very slick, and much cheaper because it's a model-based approach. So I think there's two ways of doing it. Obviously, you've got self-investment, so you just need a platform. You trade yourself. There'll always be people who want to trade themselves, and you'll never be able to convince them otherwise. That's not our target market. You've got people who actually need a way into the markets. They're not interested in doing it themselves. They just need somebody to do it for them. But I think that's where, at the lower levels, the automation comes in, and people don't mind artificial intelligence or a non-personal service at a certain level. I think there will always be a place for what James and I do, because as their wealth grows, as their life becomes more complicated, and as their needs change, and the need actually, if I had £1 million, I would want to speak to somebody.
Yeah.
I wouldn't just want a computer to do it. So I would want to go, I want to have a chat with them. I want to be able to pick up the phone. It could just be me, it could just be my era. But I just think you'll get to a level whereby, people go, they sell the business. So people are selling the businesses now for 10, 20, 30 million plus. Well, I don't want a computer running that. So there'll be a level whereby it's human interaction will always be there, in my view. But I think you've got to have both. I think automation in the early years, and then the James and the Garys at the other side.
No, I think that makes sense. Amount is crucial, isn't it? When it is something at a lower level, people may be attracted by things like eToro, but then as it goes up, they will always want protection. Therefore, they would need human involvement. No,
yeah, but and also that's just the investment side. Obviously what we do is a lot around financial planning. So the likes of pensions, you can't just go and set up a pension on your own. You need financial advice. Sure. Around that. So, these are just purely investments. As soon as wrappers like offshore bonds, trusts, pensions come into play, again, you need your financial advisor to be with you on it. It's not something that you can do yourself.
Yeah, thank you. There's some questions on the chat now. Starting from Nathan.
Right, hold on. What's the question?
Thanks, Gary and James. With increases in inflation that high, there is possibility inflation will not be temporary. How do you at Broom Dolphin prepare for a future when inflation continues?
Yeah, so we've got conviction in our belief that it is transitory. we aren't subscribing to the view that it's going to be at 4% long term. We think it could be there short term, and so we are positioning portfolios on the basis that it'll be there for the next few years, but then it will subside. If our views change, we'll start to tweak portfolios to reflect that view. But at the moment, we're not going to put any form of extra hedge in just on the off chance that it does turn into something more. I think, with inflation, you got to remember inflation's a 12-month number. So we've had high inflation now. For inflation to be at 5% next year, you've got to have very similar underlying price growth to the elements of inflation, and then for it to be 5% the year after, it would take oil to be at significant levels above where they are now for us to still have high inflation. It's the same with material costs. Material costs, steel's gone up 30%. There will be a pinch point, where consumers go, I'm not paying that. I might need a loft conversion, but I'm not paying that price. So they'll stop and they'll wait, and eventually supply and demand will be a bit of balance, a bit like the shipping. Shipping costs are high. Eventually, shipping costs will level out. They may not fall, but you don't need them to fall. You just need them to level off, and that is enough to keep inflation static, as long as they're not keep rising by the similar levels. So you've got to, if inflation is going to stay at 4 or 5%, that requires underlying price pressure for significant periods, and I can't see that happening, because the only way I could see that happening is if wage inflation follows suit. So there's lots of pressure. The NHS has been saying 3% isn't enough, inflation's going to be 4, we need 4. That's a dangerous position to be in, because if they get 4, yes, I could see inflation keep ticking higher, because people are 4% more in the pay packet, will go and spend it, and then that feeds it. So it's a vicious circle. So if we can keep wage inflation on average lower than the real level of inflation at the moment, that could help inflation subside. But we will, if need be, we will change things, and we might have to be careful. But I don't think, we certainly don't think inflation is going to stick at these levels long term.
Thank you.
James, do you want to answer Jacob's?
Yeah, for someone looking at getting, it's gone. Yeah, job in the industry, what advice would you have? Good question. I think especially when I was in your position, was you hear from companies or you have career days, and generally, yes, you think, well, I'll just do really well in my exams and I'll get a good job at a finance company or whatever. Don't get me wrong. Yes, I would definitely be an advocate of doing well in your exams if you can. But what the main one for, and I think Gary would back this up, is you've got to show an interest. Now, showing an interest doesn't mean that every single company on the FTSE 100 index and what their PE ratio is. Yes, it probably shows you a little bit of a stickler for data and stuff like that. But generally, you've got to be a people person, especially in wealth management. You have to know how to speak to a person. You might have all the technical knowledge in the world, but if you can't relay that in a nice, easy, sensible way to a Mrs. Miggins, for example, then generally you might be in the wrong area of finance. So generally, you've got to work out what you may be interested in the big world of finance, and then you've got to go out and figure out a way in how to look different to everyone else that's trying to get into the industry, whether that's a work experience, whether that's traveling abroad, setting up your own company. And just it's obvious when someone comes across interested and well prepared. And enthusiasm carries a long way. You've seen a lot of big finances, big entrepreneurs out there. They're big personalities. They might not be the best brains there, but they've done phenomenally well by being able to speak to people and showing how passionate they are about what they want to do. So that's what I would say.
Okay. Thank you very much. I'll answer this next one. Typical working day like a proven dolphin.
I think these questions, Gary, are also an implied request to ask, how about Brewing Dolphin? Is there an opportunity for us? How can we grab them?
Yeah, you just got to keep an eye out on LinkedIn, on our careers page on our website. So we've just taken on 4 or 6 people in this during the summer. So
roughly,
keep an eye on.
I can understand that the company is a progressive one, hence the reason why even the branches are spreading out. But generally, over the course of a year, how many new employee we may be attracting, just on average?
New starters, you're looking at, on average, is more than it used to be. It was definitely periods where we wouldn't recruit at all. More recently, you were looking at potentially 1 or 2 a year.
Oh, yeah.
Yeah,
And
so
I think that'll be sustainable going forward, given the demands we have.
Yeah.
Okay.
So a typical day, I'll quickly run through my week this week, so you can have a see how different it is. So yesterday I was up in Northumberland, had tootling around, had a couple of client meetings. So I did that, give them an update on the portfolio, see what the financial circumstances was. We do that every year with everybody. So I did that with these two yesterday morning. I got back home, I had an internal meeting I had to attend via Teams, and then I had 2 more client meetings via Teams because they don't live up here. Usually we go down and see them, but they wanted virtual meetings this time. So one was at 4 o'clock and one was at 6 o'clock. And then, so, we had, again, so that as a result of those meetings, there's potential some changes we need to make to portfolios, because one lady wanted to increase her income from the investments for various inheritance tax planning reasons, and look to reduce the level of capital growth that we're getting. So we're going to tinker around with that. Today, I've been in the office since 7:15 because we had stuff on this morning, and I had a meeting with a media company this morning. I then came back and had to write up the reviews from yesterday. We're then doing this lecture, so we do a lot for the community as well. I've got a client meeting I've got to go to for 3 o'clock in Team Valley, and then James and I are at the Newcastle United Foundation Awards dinner tonight at St James's Park, which will finish at 12 o'clock, so that's quite a long day. Tomorrow I've got some training, because we're always undergoing training, and then I've got a client up in Northumberland I've got to go and see, so that's tomorrow taken care of. Thursday I'm playing golf. I think that's long overdue. I deserve it. No, it's prospecting. So we obviously, a lot of our business is trying to find new clients, bring them on board. So and one of the best ways I've found doing that is golfing. There's a lot of, I've made a lot of good contacts, as has James, that way, and so I'm doing that with some prospective clients on Thursday, and then I'm at a technology awards dinner on Thursday night at the Civic Centre that we're sponsoring. So we've got that, and then on Friday I've thankfully taken the day off, but I've also got a black tie dinner in Middlesbrough on Friday night for the Middlesbrough Football Club Foundation Awards. So that's not a typical week, as a busy week, but it gives you a flavour of, we have to be out and about, looking after clients, managing investments, and actually trying to bring in new business.
That's interesting.
And James just puts his feet up all day.
Yeah. All right. Less about that better. Yeah, it's busy. Right. I'll whiz through these ones. Crypto. What's my opinion? Big old question on this, so I'll try and keep it short. In short, I think there will be a place for crypto at some point in the future. However, with 6,000 different cryptocurrencies as of 2021, and the fact that the FCA has banned the sale of them to retail investors, there's something telling you that something's not quite right in the fact that, could it be the next big bubble? Potentially. The fact that the regulator has stepped in and said we can't sell them to clients shows you that I think people underestimate the amount of risk that there are, given the fact that the visibility in these things is almost tiny. NFTs might be a bit of a place in terms of the sort of the JPEG assets, the blockchain, all that type of stuff. There's definitely going to be a place for that in the future. What that materializes, I'm not sure yet. However, by what I said before, 6,000 different cryptocurrencies and all these things, it's a battle to see who wins. It's a big market crash at some point. It's media focused as well. The amount of media attention around these things has been phenomenal, and it's I do worry about the sustainability and risks associated with the topic.
And it's not something that we can invest in. So, it's staying out of our hands at the moment. Although, again, you get a lot of, particularly technology business owners who I know some who buy into it, and, they've made a lot of money out of it. That's fine. I think we've got to know what we're here for. We know we're here to look after basically clients, pay for money. We are at their lifestyle pot. We'll make sure they don't run out of money during their lifestyle, and they can lead the life they want to live. If they want a high risk pot, they can go and do that. I think that's exact. That if they want to risk it all, that's fine. The one thing I read many years ago, because I must be honest, it goes over my head a little bit, and I was always told, don't invest in something you don't fully understand. So I don't.
But one thing that I did read was, well, do you know what? Stick one, if you can afford to put 1% of your net wealth into something and then just forget about it. And you think, well, do you know what? It's not going to break the bank and it might just come good in a big way. So it's all about being measured with it. It's about making sure you don't have all your eggs in one basket. And if crypto's something that you want to get involved with, we can't advocate it. But if you find a way of doing it and it's not going to bankrupt you, then that's your decision. It could well, it's too volatile for us. Like I say, we've got our hands tied behind our back because we can't invest in it anyway. And I'm an old fuddy-duddy and I haven't got a clue about that sort of stuff. But it will come back and bite me, no doubt. And then dark pools.
Do you think the dark pools are good for markets? I think from James, I think from your question there, you clearly know what a dark pool is. I think whilst obviously this could be a big old topic of conversation here, is the service purpose and the fact that liquidity is a massive thing for markets. And when you've got the size of these investment houses around the world that are selling millions of pounds and dollars each day, volatility is huge in the marketplace. And I do worry at times, don't get me wrong, from the lack of regulation in that market. Yes, there's going to be problems, but the fact is, a lot of with these algorithmic traders, you can come in all of a sudden and the market's down 4%. Generally, the market will find its price regardless of the dark pools, because of the amount of money that's transacting per day. So yeah, I'm kind of split on that opinion. I don't know if Gary, do you have an opinion? But I'm just split in general. It definitely serves a purpose, but I get why they're not seen to be great. Thanks for reading. Thanks. What sort of qualifications do you need to get into wealth management? Good question. For me, I need a 2-1 degree to get into Brew and Dolphin. I think being progressive and modern and new, I think you can have a really good life experience and have different set of knowledge and a different degree or no degree. You don't need a specific qualification to get into wealth management on the whole. We've a lot of the new starters that we brought on, they're actually under our apprenticeship scheme. One in particular didn't go to university. However, and Gary would probably agree, she's one of the hardest workers in our team, and she knows her stuff. So I know that's a bit vague, but what I would want to portray is you do not need a specific qualification to get into wealth management. However, if you do, it's not going to harm you.
But what do you do when you join us, James? Because you go through professional qualifications after that.
Yeah, exactly. So if you came on board and had a professional qualification anyway that the company would pay you to go through, then, well, obviously the company would shine you in good light in the fact that they don't have to put you through them if you don't need to. But yeah, once you join Brew and Dolphin, really quickly, you do a thing called the Investment Advice Diploma. I think this has been recorded, which is level 4. So it's about A-level standard to get everyone to grips with financial markets, etc. Brew and Dolphin then want to have a level 7 Chartered Wealth Manager qualification with the CISI, and that's basically the gold standard for wealth management. And it's on par with the it's just gone from and
that's called the
CFA
Masters in Wealth Management.
Yeah, it's on par with the CFA, and especially in a wealth management job, if you had the Chartered Wealth Manager qualification, it would be preferred over the general sort of CFA. Not knocking the CFA whatsoever because it's difficult, but
what you tend to find is, sorry, James, we've got different career paths. You see, you've got financial planners, which would do their financial planning qualifications. The Masters of Wealth Management is to do what James and I do as a job, to advise clients, consumers. And then the CFA is generally used if you're going to be an analyst and you're going to be pulling through accounts, or a portfolio manager who's just basically looking at investments and not dealing with people. So you've got to make sure you know what route you want to go down, and then you'll know the type of professional qualifications you'll need, because you don't want to waste time doing a CFA if you're not going to be just looking at investments and you want to advise clients, then you've got to go down a different
route. First one, what ways do you go about bringing new business into Brew and Dolphin? Good people to ask. Lots of different ways. We would love the idea for someone to ring up Brew and Dolphin and say, I've got £1 million, can you have a chat? That would be great. And I think that's going to be an area of the business we're going to focus on in terms of social media, etc. However, you're not going to invest £1 million with someone you don't know. So whether that's meeting them on a golf course, a dinner, a networking event, friends of friends, what we can overlook at times is the power of our own clients. If you've got a client that says, by the way, these have done a cracking job, you need to speak to these people, then that word gets around. And especially it's not old money anymore, it's new businesses, new money, where the fact that you've got a business owner that's been successful and they like to network. So if they're happy, that goes around very quickly. And Newcastle's fortunately the type of city where word and the reputation goes a long way to bring new business in. But I'm not saying it's easy, it's hard. It's very hard. It takes
time
and effort. And it's the consistency of keeping in touch with people. Some people are quick to jump on board. Some people are like, to the point, yep, I've sold my business, needs help, let's get on with it. Some people like the chase, as you can imagine. Some people think, I'll sort that out at some point, and it takes a longer time.
My advice is to be yourself, and be patient, because people deal with people. If you pretend to be somebody you're not, you'll get found out. And people, just be yourself, and it will come. Do the right thing. Our culture is about genuine, ambitious, and what's the third one?
Sorry, I was looking at the next question. What were you saying?
Genuine, ambitious, and expert. So that's our three things that we live and breathe by, Brew and Dolphin. And, I think being genuine, ambitious, and expertise, it summarizes that. Just be yourself, show your knowledge, and it will come, and be patient. One of the best bits of advice I was given by a chartered accountant was, just because somebody might not sign up with you now, don't forget about them, because they may make a mistake by going to a competitor and they might regret that. You always leave the door open for them to come back. Keep in touch. If they don't want you to keep in touch, that's a different matter. But you must always, don't just end it there, because, it will come back. So, but people think it's going to happen overnight, and it doesn't. It is a trust thing. Trust's massive in our industry. You've got to build that trust with people. It is their livelihood that you're looking after at the end of the day. James, that's your question, because you.
I know at the start James mentioned something. Yeah. Did I? I don't have a specific reason. However, I would say that you've had probably the ones off the top of my head. I think it's not so much why they're wanting to invest their money, like a weird reason. I think what I was meaning to was there are certain clients that Gary and I look after that you would never think have the money that they do, given their personality, their age, etc. We've got a client in particular that lives up Northumberland way, and you would meet him on the street and you'd think a lovely old man, dresses very, very adequately in terms of just like normal dress. You would never know. Got a massive interest in collectibles and stuff like that, and he's worth a fortune. And if you pass him in the street, you wouldn't think he's Elon Musk or Richard Branson, and he's a lovely person. So that's what I was kind of meaning, is you can't ever really think that's an old person, they've got no money, they don't want to invest with Brew and Dolphin, when they could be worth an absolute fortune. So give everyone their time of day, because you'll never know where it might benefit you. So that's what I was meaning.
This person phoned me up one day and asked if he could he afford to buy a new DVD player because it had broken. I was like, absolutely. Go and splash out.
Yeah, we just have 1 minute left now. So maybe any final question? Anyone? I think we all are very happy, Gary, James. Very quickly, I wanted to mention about the type of assessment that we ask students to complete. This particular assessment requires the students to have a passive portfolio, which they would date back and assume that they started investing 5 years ago. So for students now, they will be investing from 2016. And whatever money they realize as of now through that passive investment, then they will make that a new investment in an active manner. So that's how we try to give students the flavor of both passive and active investment management, where Bloomberg has a big role to play in terms of the learning architecture. So maybe in the future, I would like to consult, practitioners like yourself to see what we can include further to see that it becomes more practitioner oriented. But but you may want to say something in terms of what you think about this particular assessment. We've got both passive, active. We teach students a number of valuation models such as CAPM, Farmer Friends, and also like simple like dividend discounting model. And they understand very well that no one model is superior than another, hence the reason why consistency is important. But then we also have few behavioral finance aspect. So they go through all of these. But time and again, I feel that maybe there's something that is lacking there in terms of what practitioner do. For example, some of the things that you have said today, maybe I have not been able to incorporate as adequately as perhaps I could have. So that's it. Well, maybe I want your time in the future just to talk about an hour or so after I will have emailed you the assessment. You may say, well, yeah, do this, something like that.
Okay, no problem.
Yeah.
No problem
All
at all.
right. But other than that, we really are very grateful on behalf of the whole of the students and my department, Accounting and Financial Management at Northumbria University. Really grateful for the time that you have spent. We know how busy you are because you told us your regular schedule. And we also know that you're not available for clients who have small money to invest.
Yeah, absolutely.
Yeah, exactly.
Yeah. So, we're really, really grateful for the time that you have given to us on a consecutive basis over the last several years. So thank you very much, Gary and James. Very soon I will be looking forward to that opportunity that we can take you to a lunch or a dinner. So we need to find that time as well. But thank you very much. Thank you. Really appreciate it.
No problem at
Thanks,
all.
everybody. Hope you enjoyed
Thanks,
it.
everyone. Nice speaking. Take care.
Bye.
Bye now.
All right. Okay. And to all my students, thank you very much for your active participation. Matt, I don't know if this is a question to me or you wanted to ask the presenting people, but now, did you raise your hand, Matt? And you have anything to ask or you've already left? I don't know. No. Okay. I will check if Anna, do you have anything to say?
No, I just want to ask not about this lecture. I want to ask, do you have a class tomorrow at 9 o'clock? Because at 11 I have an appointment at police.
Oh, everything is okay. Yes, Anna, it's the regular police thing that you need to do because you are an international student. Yes.
Yeah.
Yes, I believe you've got a class, but not with me this week. With Jerry at 9. At 9 o'clock. But is it a workshop? Today is Tuesday, so you're talking about the workshop, isn't it?
Yeah, because my workshop is on 10 o'clock and
I can fully understand the reason why you cannot be there, so don't worry, but thank you very much for informing us. Should you have any question related to the part that you have missed, you can always ask us, or it may be a good idea to join another session. So I'll mention to Jari about what you just said to me, okay? And try to see if you can just take part in another workshop session for this week. Is that all right?
At 9 o'clock tomorrow? Oh, you don't know?
You see, when I was delivering, it was 9 to 10, 10 to 11, 11 to 12. So I had 3 consecutive workshops for the same question. So and I know this is the pattern for Jari as well. So you can join at 9 if you think you want to wait.
Okay.
Or you can join on Friday, which is absolutely fine. Friday, we also have 2 sessions. So don't stress yourself. Just finish your part with the police registration and be there on a Friday. Maybe that's easier, Anna.
Okay, thank you.
All right, very good. Now, anyone else with any question? No? So, you see, having heard Gary and James today for that long, I know that we still have like half an hour or so remaining if you think of the timetable, but we will leave it for today, okay? And we will meet on the workshop time for this week, and we'll also explore on what Gary and James said, including some questions that will be related to efficient market hypothesis topic, okay? Yeah, all right. Nathan is saying, thank you, Binam. Would be happy to hear from both Gary and James in the future. Seem like, yeah, no problem. That's fine. And yeah, I can see so many of you have been thanking Gary and James for their valuable time. So, yep, you all are welcome. Okay, so we call our day for today. If the recorded material has worked well, if the recording is there captured adequately, then I will be really happy to post it as our discussion session that we completed today. Okay, so if recording has been captured, which is something I was doing here, and then I will be posting it. I hope this will work.